Welcome to Implied with Zein, where conversations about value, strategy, and market signals are unpacked for the GCC markets, with insights that travel far wider.
Welcome back to Implied. What's common between Talabat in the UAE and on-demand delivery platform, SABIC in Saudi Arabia, a global petrochemicals giant, and random agribusiness in, say, Brazil? I'll come back to that in a second. In episode 1, I mentioned that many companies are still building the foundations to fully understand their intrinsic value. Our markets are mature in areas, but still very young in other areas, so the early episodes are not really intended to be Finance 101, but to lay some of those foundations and bridge the gap many investors face when assessing new companies. So back to the main question. Talabat, SABIC, Brazilian agribusiness, different industries, different geographies, different business models. Well, the answer is they all share the exact same core value drivers. Let me explain. When you strip the valuation down to its essence, and here I'm leaning on first principles thinking, a company's value comes from two things. The first are factors significantly influenced by management decisions, and the second are external factors like taxation, inflation, and interest rates. Of course, companies can optimize their taxes and tweak their capital structure, but for now, let's focus on the ones influenced by daily decision-making. And these are revenue growth, operating profit margins, and investment requirements. Simply the fixed and working capital investment required per dollar of revenue or incremental revenue. That's it really, just these three drivers. The same value drivers across most industries, aside from special cases like banking and insurance. Now, you might argue, and you wouldn't be wrong, that these factors are also affected by external forces. They are, but in practice, the weight of influence often sits with management decisions, and that's what makes them worth discussing. Now, there's a hidden fourth driver, and it's basically how long you can keep generating returns on capital at an above-average level. That is what's commonly called the competitive advantage period. Two companies can have identical growth, margins, and capital intensity, but if one of those can defend those economics for 20 years and the other only for 5, then the difference in valuation can be quite significant. And that is the angle through which investors judge whether today's economics are temporary or durable. We will discuss this properly in another episode. But for now, let's call the three drivers I just mentioned level 1 of the value driver tree. And yes, level 1 gives you the big picture. It's great for investment assessment and high-level screening. But to really manage performance and actually diagnose underlying problems, we need to break them down into level 2. And level 2 is simply the operational levers that drive those big numbers. So let me dissect the three big drivers. And I'll start with the building blocks of revenue. These typically come from three sources: volumes, prices, or the price mix. And that breakdown matters a lot because each one of those has different dynamics and trade-offs. For Talabat, revenue drivers could be active users, order volumes, the average value of those orders, and the commission rate that Talabat charges its customers. For SABIC, drivers are how much of their capacity is actually being used, sales volume, chemical prices, and whether they're selling at a premium or a discount. For the Brazilian agribusiness, drivers are the size of the farmland, yield and productivity, selling prices, and how much crop gets spoiled before it can be sold. Different industries, different metrics, but you get the idea. It's all the same structural drivers. Now, the cost drivers, this is about what's actually behind the key costs, the ones that materially shape operating profit margins, the structural costs. And these drivers respond to scale, they respond to efficiency, bargaining power, process changes, and sometimes just better decision-making. For a company like Talabat, think delivery network efficiency. Think the cost to keep the platform and tech infrastructure running. And think Talabat spending on marketing. For SABIC, key costs are driven by feedstock prices, input conversion ratios, energy costs, logistics, and labor. Each of those is volatile in its own way, and each one can swing margins hard, especially in a commodity business. For the Brazilian agribusiness, costs typically include fertilizer prices, labor costs, transport, fuel, and even the weather, because when the weather ruins part of the crop, costs on a per unit basis go up. Finally, let's look at investment requirements. And this is simply how much investment is required to maintain today's revenue and drive future growth. It covers long-term investments like fixed assets and intangibles, simply capital expenditure that's expected to generate revenue beyond 1 year. And it may include acquisitions, which are just another way to invest in long-term growth. Investment requirements also account for short-term investments in the sales cycle. In other words, the cash conversion cycle, inventory, payables, receivables, the working capital cycle. Improving the capital intensity often comes from scale. With more bargaining power, bigger companies can and do negotiate lower capex per unit and optimize their cash conversion cycles. Improvement can also come from reconfiguring the production model. For example, relocating to lower cost markets, streamlining processes, or reimagining the whole production model altogether. Now, these three drivers, revenue growth, margins, investment requirements, they don't operate in isolation, of course. A manufacturing company that's hit its capacity limits can't significantly grow its revenue without investing in new capacity. They will also incur pre-production costs, and all of that can dilute margins, at least initially. So why does this all matter? Well, first, because companies don't actively map these drivers into a detailed value driver tree. And notice I said value driver and not profit driver tree, and we'll see why in episode 4. Now, many companies definitely know their numbers, but usually in isolation, and they rarely connect them in a way that shows where value creation is truly coming from. The best companies I've seen break their drivers down into their building blocks and then the drivers of those blocks and so on, until they've mapped the most important quantitative and qualitative levers. The second reason this matters is because many companies focus their corporate targets and reporting hygiene only on revenue growth and profitability. They completely ignore investment requirements and cash flow conversion. And this is like telling the story of value creation with only 2 out of the 3 chapters. That story is incomplete. The third reason is that many companies don't actively maintain investor-grade financial models. Basically, a model that mimics how an investor or analyst would assess the business from the outside. Honestly, many companies don't have a regular view of their own intrinsic value at all, which leaves them at the mercy of the market's version of their story. And we don't want that to happen. So what's implied here? Well, the real foundations of value creation are much more simpler and much more universal than we might think. Revenue growth, margins, investment requirements, they all apply whether you're running a delivery platform, a chemicals giant, or a farm. If you ignore one, you're not telling a full story. But if you map them and connect them, you give both management and investors a common language for value. In the next episode, we'll take this one step further, because once you've mapped your value drivers, the real test is how you allocate capital against them. And that's where value is created or destroyed. I am Zein, and this is Implied. Thanks for listening.
You've been listening to Implied. If you found this useful, follow the show and share it with a colleague or friend. It helps more people discover the conversations. For episode alerts and show notes, subscribe at impliedpodcast.com. And if you have thoughts, questions, or even pushback, we'd love to hear from you. Remember, nothing here is an endorsement or investment advice. Thanks for listening, and see you next time.